Hello again, Advanced Vita volunteers. So this lesson we are going to look a little deeper into other taxes. Both of the topics that we are covering we briefly touched on when we were learning our basic certification. But we just touched on them for awareness, and now that we are working towards the advanced certification, these are things that we will be able to do in the field for our clients. So this is in regard to unreported tips and exceptions to the IRA penalties for early withdrawal. So let's start with a little review of tip income. If you'll recall, tip income is always reportable for income tax purposes. Sometimes the employers know how much in tips their employees are getting because those tips run through the employer's payment system, but sometimes tips are received in cash or through another route. So it's the employee's responsibility to let their employer know if they received $20 or more in tip income per month, and that's per job. If for any one employer that they received that $20 or more in tip income that month. So then they report it to their employer, and then the employer should be including that in box 1 of the W-2, which is the taxable income. And again, we briefly touched on when we were looking through the W-2, this box 8 of the W-2, which is for allocated tips. And that's when an employee reports fewer tips than certain employers expect, then those employers will allocate some tips to that employee, and those employers are required to do so, which we won't go into the employer side of things. But if we have somebody come in with an amount in box 8 allocated tips, that is what that is for. And they may have received those tips and didn't report. They may have received more tips than that and didn't report, or they may have received fewer tips than that, and we really hope that they kept a log of the actual tips that they received, because then we might be able to help them not have to pay tax on money that they didn't receive, or on income that they didn't actually get. But they will have needed to have kept a log about that. So there is an entry field in the W-2 entry screen in TaxSlayer, and so that allocated tips will find its way onto the return as long as we are making sure that we are getting everything, doing a good job with our data entry. For unreported tips, and that includes the allocated tips because the employer allocated them, the employee did not report them, we have that $20 threshold. And it's important to note that the under $20 per month is still reportable on the tax return, because there's still going to be income tax on those tips. If there was more than that $20 per month per employer, then it's not just income tax that needs to be assessed on that tip income, but also Social Security and Medicare taxes. So these will get figured on Form 4137, the Social Security and Medicare tax on unreported tip income. And you can see in that first section there's a number of lines, so a taxpayer could work for a number of different employers, and then there's some columns where they state the amount of tip income that they got, they state the amount that they reported, and then they state the amount that they didn't report. And then in that second section down below, there's some calculation lines. In amongst those is a place to put tips that were not reported because they were under that $20 per month amount. And so when that happens, it gets subtracted out of the amount that has to have the Social Security and Medicare tax paid. And this is all done on a per month basis. So we need to know what to do when we get to TaxSlayer and we have this sort of situation. And there's a couple of different types of scenarios. So if there are unreported tips, then we would enter them on the W-2 input screen. There's a field for unreported tips. That's important to note. That's not a box that you actually have on the W-2. This is something that, you know, as we have clients come in and we see that they're working in an industry that receives tips, we want to make sure to ask them, hey, did you have any tips that you didn't report to your employer that we need to make sure end up on the return, because they are taxable for income tax purposes, and they might also need to be added to your Social Security and Medicare income. So when we find out that's the case, then again, there's that field in the W-2 input screen. So that's a field that we need to have interviewed our taxpayer to find the correct amount to put in there. Now, if those tips were unreported because they were less than the $20 per month, then we would also enter them on Form 4137 in the Other Taxes section of TaxSlayer. So that allows that amount to be taken out of TaxSlayer's figuring of what needs to be reported for Social Security and Medicare tax. So again, that will still be calculated in the income tax portion, but they won't have the added employment taxes. So if the allocated tips, so this is a situation where, you know, we have a taxpayer come in, they've worked in a service industry, and they have the W-2, and that box 8 it has a number in it for allocated tips, and they say, I didn't get that many tips. And then we say, oh, did you keep a log? And hopefully they kept a log of what their actual tips were. So if their log says that their actual tips were less than the allocated tips, then our entries are to leave the W-2 box 8 empty, and then we report the actual amount in their log in the unreported tips section. So next we're going to look at the exceptions to the IRA penalties. And not just IRAs, really any kind of tax benefited retirement plan. If you'll recall, when we looked at the 1099-R, and we talked about that all-important box 7, which has our distribution codes, and if you remember, box 1 is kind of our uh-oh distribution code. That means that the taxpayer took an early distribution, and the trustee, the entity that was holding this money, the account, didn't know why or didn't know of any exceptions that applied to the taxpayer having an additional tax. So, and if you recall that generally speaking, if this was a tax favored account, the taxpayer will need to pay income tax on this distribution, as well as an extra 10% penalty for an early withdrawal. However, just because the trustee didn't know that there was a exception doesn't mean that there actually wasn't one. So one of the most common ones is when the taxpayer did what's called a 60-day rollover. So if the funds are deposited, they were taken out of the one IRA and deposited into the same IRA or another IRA or an employer plan within 60 days, then that's considered a rollover, and so that's an exception to having to pay a penalty on that income, and it's also an exception to paying the income tax because it went right back into another tax favored account. So our taxpayers can only do this one time per year, and that's the 60-day rollover. They can have unlimited trustee to trustee rollovers, so that's where that money goes directly from one account, one tax favored account, to another tax favored account, and our taxpayer never received a check or anything. With the 60-day rollover, the taxpayer receives the check and then deposits it into the account themselves. So they only get to do that one time per year. And then when we go to enter these 60-day rollovers into TaxSlayer, we'll do it on the 1099-R input screen. Again, we're going to be seeing a 1099-R with a code 1, or it could be a code 7 if they are above the 59.5 age. Then they still would, if they had this rollover, they would still want to make sure that they didn't have to pay the income tax on a rollover. So when we're on that 1099-R input screen, we subtract the rollover amount from the gross distribution box 1 and enter the difference as the taxable amount in box 2A. So box 1, to clarify, you put what's on the 1099-R in box 1, and box 2A, remember, is that taxable amount. So that taxable amount we lower by the amount that was rolled over, and hopefully it was all of it, but sometimes it's not. So we just lower by the amount of rollover. And then there's a checkbox at the bottom of the 1099-R input screen where, again, we check the box that says that this was a rolled over distribution, and we put the amount that was rolled over again. Another exception to the IRA penalty is for adoption, and in this case, taxpayers can take up to $5,000 as long as they do it within 1 year after the child is born or the adoption is finalized. In other cases, it's possible that the taxpayer was totally and permanently disabled, for whatever reason, the trustee didn't know about it, maybe in the first year that it happened. But it's important to note that this total and permanent disability has to occur before the distribution. Otherwise, the distribution would still have to have that 10% penalty. Death is another situation where a distribution made on or after the date of death would not be subject to the penalty. For medical expenses, we can have an exception to the penalty for up to the amount that was paid for unreimbursed medical expenses during the year, minus 7.5 of the adjusted gross income for the year. So this is very much like we talked about with our itemized deductions. Remember, the first 7.5% of AGI is not deductible. So in similar fashion, the first 7.5% of AGI cannot be excluded from the taxability or the penalty on this. It's important to note that taxpayers are allowed to get the exclusion from the penalty and also be able to deduct the expenses on Schedule A. It's not a double dipping situation because the only thing they're being excluded from is that 10% penalty when we do this on the IRA side. So unless they deduct it on the Schedule A side, then it would still have been taxed at their ordinary tax rate, the income. But they shouldn't have to be taxed based on that because it is a deductible expense as well. And then IRA distributions that were used to pay for qualified higher education expenses can also be accepted from the penalty, from the 10% penalty. Again, they would be taxable for the ordinary tax rate. They just wouldn't have that additional 10% penalty. However, if the education expenses were covered under the Pell Grant or some other tax-free education benefits, then you can't double dip on that. And so in that case, they would still have that penalty. Also, IRA distributions can be used for the purchase of a first home, but it's limited to up to $10,000 per taxpayer. So if you have a married filing joint couple, it could be, and they each have an IRA, it could be $20,000 between the two of them. Then also, if the distribution was made due to an IRS levy on the qualified retirement plan, that's another exception to the 10% penalty. And I think we talked about this a little bit before when we were in our basic certification lesson, where we were talking about, if there was an early distribution, TaxSlayer will automatically calculate the penalty and put it on this form 5329. That is also where the exceptions to the penalty get reported. However, we do need to enter those exceptions in manually because when the 1099-R was input, we put a code 1 which said that there were no exceptions that were known of. So that's when our interview skills kicked in and we were asking our taxpayers, gee, did this apply? Did that apply? Did you pay for education expenses or a first home with this money? Did you have really a lot of medical expenses? Let's talk about how much. Let's look at your income, your adjusted gross income, and see if you might qualify for an exception. So the exceptions are entered on the form, which is located in the other taxes section. So when you get to other taxes, you're looking for form 5329, and then you can from there enter in what exception applies, if an exception does apply. And then it's also important to note for this form that only Part 1 is in scope. There are other kinds of taxes that can be assessed on these kinds of accounts. If people are having excess contributions or they're not making distributions in time when they get older, those situations are out of scope for our program. So this is just when people are getting those early distributions and there is an exception that we are able to work with this form.